The sharpest investor in your entire building is the woman who completely forgot her account existed. Not Marcus. 2 desks over, refreshing a trading app through a cracked phone screen at every single red light. Marcus has made about 200 trades this year. Elena in accounting made exactly 1 trade back in 2019, then lost her password and never logged back in. Guess which one is winning? My name is Yank, and I've spent an embarrassing amount of my life watching people work incredibly hard to get poorer. Because here's the thing nobody selling you a course wants to admit. Building wealth might be the only job on earth where effort is a penalty. Where the more you touch it, the smaller it gets. Where the person doing almost nothing quietly laps the person doing everything. Today, I'll show you the laziest, most boring, almost insultingly simple way to actually get rich in America, why it works, and the one uncomfortable reason it still isn't easy. Marcus is going to hate this. Elena already won. So leave a like and let's get into it. Now, I need to define what I mean by lazy, because I don't mean broke and hoping. I mean a very specific kind of lazy. The kind where you make 3 or 4 good decisions once, automate them, and then spend the next 30 years aggressively not touching them. That's it. That's the whole strategy. And I know how that sounds. You clicked on a video about getting rich and the big secret is do nothing. Stay with me, because the reason this works isn't motivational. It's mathematical. It's measured. And it's honestly a little insulting to everyone who's been grinding. And if you're sitting there right now feeling like you're already behind, like everybody else got some memo about money that skipped your inbox, relax for a second, because this is the one strategy where being a little lazy is almost an advantage. Here's the setup, and it's the whole video, so hold on to it. Marcus and Elena make the same money and put away the same $500 a month. Marcus manages his, Elena forgot hers. We'll check in on both of them the whole way down, and by the end, you'll know exactly which instinct made one of them rich. Let me show you the receipts. Let's start with the thing that should make Marcus nervous. There's a scoreboard for professional investors called the SPIVA Report, published by the people who run the SP 500, and it does something beautifully cruel. It takes every fund manager whose entire job is to beat the market and checks whether they actually did. These are people with Bloomberg terminals, teams of analysts, and salaries with a lot of zeros. And over the 15 years ending in 2024, almost 90% of them lost to a simple index fund that a sloth could run. Not 40%, not 60, almost 90. The professionals, the ones who do this all day, mostly lose to the strategy of buying everything and going back to sleep. And here's where it gets genuinely funny. Your instinct is, okay, fine, I'll just pick the ones who did win. Find the hot fund, the 10% that beat the market, and ride it. Except the same report checked that too. They took the top performing funds from one year and followed them. Of the funds sitting in the top quarter in 2020, 4 years later, exactly 0 of them were still in the top quarter. 0. Winning one year told you basically nothing about the next. It's like trying to get rich by memorizing which slot machine paid out yesterday. Which brings me to my favorite story in all of finance, and it's completely true. Back in the 80s, a manager named Peter Lynch ran a fund that averaged roughly 29% a year for about 13 years. That's an absurd Hall of Fame number. Here's the punchline. Fidelity, the company that ran the fund, later looked at how the average investor in it actually did. And the average investor in the single best fund of the era, run by a certified genius, lost money. Let me say that again, because it's the whole video in one sentence. The fund made a fortune. The people in the fund lost money. How is that even possible? Simple. They bought after it went up because they got excited, and they sold after it went down because they got scared. They handled it. And every time they touched it, it got smaller. There's an old line that a bar of soap and your investments follow the same rule. The more you handle them, the smaller they get. And we can put a number on the handling. A firm called Dalbar has spent decades measuring one specific thing. Not what the market returned, but what the average human being actually earned after all their clever moves. Over the 20 years ending in 2024, the market returned about 10.25% a year, while the average investor earned about 9.25%. That gap, a little over 1% a year, doesn't sound like much, but over 20 years it means the market ended up worth roughly 22% more than the average person actually captured. They paid a fifth of their wealth for the privilege of doing stuff. And the single most expensive kind of stuff is trying to time it. Getting out before the crash, getting back in before the recovery. This feels smart. It feels responsible. It is financial poison. And I can prove it with one statistic I think about constantly. Take 20 years of the S&P 500 from 2003 to 2022 and imagine you invested $10,000 and never touched it. You'd have ended with about $65,000. Now imagine you did almost nothing different. You stayed fully invested the entire time, except you happened to miss the 10 single best days. Just 10 days out of about 5,000. Your $65,000 collapses to under $30,000. Missing 10 days out of 20 years cut your money by more than half. And you're thinking, fine, so I'll just avoid the bad days and keep the good ones. Here's the cosmic joke. You can't, because they're neighbors. 7 of the 10 best days over that stretch happened within 2 weeks of the 10 worst days, right after the crash. On the exact days you'd have sold in terror and gone to cash. The market's biggest gifts are hidden inside its scariest moments. So Marcus, refreshing his cracked screen trying to dodge the storm, is standing outside in the rain having already sold his umbrella. And it's not because he's dumb. It's because the human brain is a terrible market timing machine. And the one thing it begs you to do in a crash, sell, is the exact thing that guarantees you miss the bounce. Time in the market beats timing the market. It's a cliché because it's just true. Okay, so trying hard, picking winners, and dodging crashes all quietly make you poorer. Now let me build the lazy machine piece by piece, in order of how stupidly effective each part is. And the first piece is so good it's almost cheating, free money that a quarter of America is leaving on the table. If your job offers a 401k match, your employer is offering to hand you a raise for the crime of saving your own money. A typical match is something like 50 cents for every dollar you put in, up to 6% of your pay. Read that back. That is an instant, guaranteed 50% return on your money before it's even invested in anything. There is no investment on earth that reliably does that. And yet 1 in 4 workers don't put in enough to grab the full match. Think about how strange that is. It's your boss trying to physically stuff cash into your pockets, and a quarter of US are going, no thanks, I'm good, pockets are full. The average person doing this walks past about $1,300 a year in free money over a working life. Capturing that alone can be worth well over $100,000. This is the laziest possible move. You don't pick anything. You don't time anything. You just fill out a form once and tell them to take the maximum they'll match. If you do one thing after this video, it's that. Now the second piece, and this is where laziness becomes a genuine superpower. Once the money is going in, it needs somewhere to land. And here's the beautiful part, the boring option is the winning option. You don't need a portfolio of 40 stocks you monitor. You need roughly one fund that owns basically the entire market. A total market index fund or a target date fund, which is a single fund that owns everything and slowly gets safer as you age, all on its own. You pick the year you'll retire, you buy the one with that year on it, and you are functionally done forever. It rebalances itself. It requires the same ongoing effort as a rock. And the data on this is almost comical. The people who set up one of these automatic all-in-one funds and walk away, in the most recent year measured, only about 1% of them made a single trade all year. 1%. 99 out of 100 just let it ride. This is Elena's entire investing career, by the way. One target date fund, $500 a month, a password written on a sticky note that fell behind her desk sometime in 2020. She is doing nothing on purpose, beautifully, and she is quietly crushing Marcus, who has now rebranded himself as a swing trader in his group chat and has strong opinions about lithium. The whole game is designed so that the correct move and the lazy move are the same move. You are being rewarded for your indifference. And before someone asks, no, you don't need to perfectly time your deposits either. All at once, spread out slowly, it barely moves the needle. Both of those beat the strategy most people are actually running, which is leaving the money in checking because they're waiting for a better moment. The better moment is a myth. The enemy was never picking the wrong fund. It's the cash sitting on the sidelines, quietly losing to inflation, while you wait to feel ready. Now you might be waiting for the catch. It's coming, I promise, and it's a real one. But first I have to show you the engine under all of this, the thing that turns small, boring deposits into life-changing numbers. It's the same force that punishes you for handling your money, compounding. It just runs in your favor when you leave it alone. Let me give you the number that should be printed on a bathroom mirror somewhere. If you invest $500 a month and you earn something like the market's long-run average, in about 30 years, you're sitting on roughly $987,000. Almost $1 million from $500 a month. That's Elena's number, the same $500 a month she set up in 2019 and forgot about, running quietly in the background of her life while she does absolutely nothing to deserve it. And here's the part that stings. Waiting 10 years to start doesn't cost you 10 years of deposits. It can cost you half your final number, because the decade you skipped was the exact decade compounding was finally going to do the heavy lifting for you. Time is the actual ingredient. Everything else is seasoning. But there's a silent leak in this engine, and it's the one thing that separates the people who quietly get rich from the people who almost do: fees. The legendary investor John Bogle laid it out like this. Imagine $1 growing for 50 years at 7%. It becomes about $30. Now let a typical 2% in fees skim off the top, so you earn 5% instead. That same dollar becomes about $10. You put up all the money, you took all the risk, and you kept a third of the reward. Bogle called it the tyranny of compounding costs. And here's the lazy person's revenge. A plain index fund can cost you 3 cents per $100 a year, while an actively managed fund might cost you 60. This is where Marcus loses without even noticing. His actively managed, hand-picked, professionally blessed funds charge him 60 cents, where Elena's boring index fund charges 3. He is functionally paying a personal trainer triple the going rate to make him slower. The expensive one loses more often and charges you 20 times as much to do it. Cheap and boring wins twice. Then you wrap the whole machine in the right container, because where you invest matters almost as much as what you invest in. In 2026, you can put up to $24,500 a year into a 401k and up to $7,500 into an IRA. And these accounts let your money grow without the tax collector taking a bite every year. There's also this thing called an HSA, which is the only account I know of that's tax-free going in, tax-free growing, and tax-free coming out for medical costs. It's a cheat code most people use as a glorified debit card. You don't have to max all of these. You just have to know they exist and feed them in order. And if you're wondering whether this boring machine actually produces rich people, let me tell you exactly who the real millionaires are. Fidelity tracks the people in its retirement plans who've crossed $1 million, and there are now a record number of them, over 650,000 just in 401ks. And here's their thrilling secret. The average one is around 59 years old and has been in the same plan for about 26 years. Not traders, not geniuses, not people who called the crash. People who put money in the same boring account every paycheck for a couple of decades and mostly forgot about it. That's Elena in 26 years. She isn't a different species from that 59-year-old millionaire. She's just an earlier chapter of the exact same boring, beautiful story. Same fund, same $500 a month, same lost password. So if this is so easy, why isn't everyone rich? Here's where I have to stop selling and start being honest. because this is the part the hustle bros skip. This entire strategy has one enormous, non-negotiable requirement. You have to have money left over to invest in the first place, and a staggering number of Americans genuinely don't. Nearly 4 in 10 adults say they couldn't cover a surprise $400 expense with cash. Among households earning under $30,000, only about 13% own any retirement account at all. So when someone tells you you're just one automatic transfer away from wealth, understand that for millions of people, the surplus that makes this possible simply isn't there. And that is not a personal failing. It's not laziness or stupidity. That's wages and rent and child care and the price of insulin doing exactly what they do. The lazy path to wealth is real. It's also a privilege of having positive cash flow, and I'm not going to pretend otherwise. And even if you do have that surplus, I owe you 2 more pieces of honesty. The first is that the future might be stingier than the past. That $1 million math assumes the market keeps returning what it historically has. And right now, the big forecasters, Vanguard, Goldman Sachs, are quietly warning that US stocks might return a good bit less over the next decade. Not zero, just less, which isn't a reason to quit. It's a reason to save more and expect less drama. There's also a specific pothole right at the finish line. If a nasty crash lands in the first couple of years after you retire, while you're pulling money out to live on, it can do damage the same crash wouldn't do 10 years earlier or later. It's called sequence of returns risk, and it's the quiet reason those automatic target date funds slowly shift to safer stuff as you age. The machine is protecting you from the one stretch of bad luck that actually matters. The second piece of honesty is the hardest one, and it's the reason Marcus exists. Simple is not the same as easy. The plan fits on an index card, but here's what leaving it alone actually looks like. It's 2 in the morning. The market is down 34%. The account you spent 8 years building just gave back $40,000 in about 3 weeks. And you're lying in bed with the app glowing in the dark, that little number bleeding red, your thumb hovering over the button that says sell all. Every headline is screaming that this time is different. And the entire strategy, the whole thing, comes down to whether you can put the phone face down on the nightstand and go back to sleep. That's the real skill. It was never picking. It was never timing. It's just not selling at 2 in the morning. Which is honestly why I built a place to help people actually do the enduring part, because doing nothing is a lot easier with company. I opened a school community where I break down this stuff in plain English and walk through it step by step. No jargon, no gurus posing next to rented Lamborghinis. If you want the boring machine set up and the discipline to leave it alone, that's where I'll help you build it. Links below. It costs nothing but the willingness to be a little bit lazy on purpose, because that's the reframe I want to leave you with. We've been sold the idea that wealth is a reward for effort, for grinding, for outsmarting everyone else. In the market, for most normal people, the opposite is true. Wealth is the reward for restraint, for setting up something sensible and then having the almost supernatural discipline to be boring for 30 years. Marcus will spend the next decade working incredibly hard, trading through his cracked screen, paying 20 times the fees to slightly underperform a fund he could have bought in a single afternoon. Elena will find that sticky note eventually, log in for the first time in years, and discover she got rich by accident on purpose. One of them will have a fantastic story about the time he almost caught the bottom. The other one will just have the money. Just a reminder, I'm not a financial advisor, and this is for educational purposes only. Everything here depends on your own decisions. But if you take one thing from me today, let it be this. The market pays you to sit still. So the next time your brain begs you to do something clever with your money, remember that clever is expensive. Boring is free. And the laziest person in the room is usually the one on her way to $1 million. Set it up once, forget the password on purpose, and go do literally anything else.